In this class, we keep on our discussion on the relationship between accounting and other business functions, and our focus is on two areas. First, the relationship between accounting and marketing function, and then we will follow with the discussion on the relationship between accounting and service provision. So let's start with discussing about the relationship between marketing and accounting. And for marketing department, we have already discussed in another class about its functions and what activities that it will do. And right now, we will discuss or share with you how does the marketing department coordinate with the accounting department. And there are some areas we would like to highlight. There are 4 areas. First, the budgeting. Accounting department will discuss the likely sales volume of each product with the marketing department in order to produce the sales budget. So in other words, without the marketing input, accounting department cannot produce, or the management accountant cannot produce the sales budget, because it needs to have the sales volume for each product projected by the marketing department based on marketing department expert, especially in the sales intelligence and other channels information. And next, advertising. Accounting department will help the marketing department in setting the marketing budget, here the marketing budget or advertising budget, and in monitoring whether it is cost effective. One example is accounting department could help in measuring new business generated as a result of different advertising campaigns. In the commercial world, it generally describes this process as ROI, the return on investment. Return on investment for advertising or marketing means that how much of advertising or marketing money spent in the campaigns and how much of the sales generated. Based on the input from marketing department, the management accountant can estimate what is the return on such marketing investment. And next, pricing. Accounting department will have input into the price that is charged. So accounting department needs to have the price information. And often products are priced at cost plus a percentage. So it's about the product pricing. It's the general methodology applied by many companies in the world, cost plus priced at cost plus a percentage. That means if your cost of the products is $50 and you assume 100% markup, so the selling price should be charged at $100 because $50 is the cost, and markup by 100% means you have to add on by $50 as well. So the total the selling price will be $100. And even if the marketing department determines the price based on the market forces, they need to consult with the accounting department to ensure that the costs are covered. So here is another methodology about the pricing. One method is cost plus a percentage. It's quite easy to adopt and quite easy to understand by every department in the company because it's just assume a cost plus a percentage. But marketing department can propose another methodology, say market pricing, benchmark with the competitors and sell at the same price or slightly different from that price. If it is the case, based on the market pricing, marketing department need to work with accounting department to see whether the costs can be covered by such methodology on the pricing. Say for example, if the market price of the product is $100, and the cost is $80, then it means that you have $20 as a gross margin by selling the items with the same price as your competitor. And finance department or accounting department can determine whether it is justified to do it because the $20 needs to cover all other overheads as well. The product cost is $80 and $20 is the gross margin. Then we need to consider any other overheads need to be considered or need to be counted in the calculation. And the fourth area that the marketing department needs to work with accounting department is market share. Here is talking about the actual sales volume, because accounting department can gather the information on the actual sales volume from the sales department or production department. So it can help to provide the actual sales volume numbers to marketing departments for each product and help marketing departments in determining market share. It's a bit different from what discussed in the budgeting, because for budgeting, it's the marketing department provide the estimation of sales volume for each product in the following period, say in the following 3 months or in the following year. But for market share, it's the actual or historical data gathered by the by the accounting department. So accounting departments can provide the actual sales volume figures to marketing department in order for marketing departments to estimate or to determine the market share of each product. And sometimes we can see the conflicts between accounting and marketing departments, and in many organizations, no matter is in the multinational corporation or SME, the small and medium-sized corporations, especially in two areas, pricing and cost control. For pricing, because as we just shared, for pricing, accounting department is concerning about the cost. So the methodology proposed by accounting department is on cost plus percentage approach. But for marketing department, they are looking for the market. They would like to look at competitors' pricing. So they proposed a benchmark pricing with the competitor on setting the product price. And there is a conflict between two departments, especially when the product price is lower than the cost of production. And marketing department will argue that because the price is too low offered by the competitor, and marketing department will say that it's about the cost control issue within the organization. So it argues with accounting department or the production department to see how to lower the cost. So there is a conflict between accounting and marketing departments, especially in pricing and cost control. And the last area that we would like to discuss is service provision or service department and accounting department relationship. Before we move on to discuss about the relationship between service or services and accounting, let's look at what are services. Some companies provide services to customers as their main business. One example is taxi service or taxi services, and there are 4 main features of services. So here we would like to share with you, other than the production or the products, some companies would like to provide the services to its clients or customers. For example, accounting firm, you cannot see any tangible products produced by accounting firm. They provide the auditing and advisory services, tax consultancy services as well. And here one example is taxi services. It's also not a tangible products. So the first feature of services is intangibility. For services, they are activities undertaken by the organization on behalf of customers and therefore cannot be packaged for the customer to take away with them. Like taxi services, the taxi driver carry you from point A to point B, and it is intangible. You cannot package the services and take it away. So it's intangibility for all services activities. And next, inseparability. Services are often created by the organization at the same time as they are consumed by the customer. So in other words, you cannot separate the organization and the services by himself. For example, a taxi driver will create the service they offer as they are carrying a passenger to their desired location, and the service cannot therefore be easily distinguished from the person or organization providing the service. In other words, they produce and then just consume at the same time. Perishability. For services, they cannot be stored for later. For example, taxi or taxi services. For taxi driver, he cannot take a customer to the same location at the same point in time twice. Once the journey is over, the service has been consumed. So at the same time, one taxi driver can only carry one passenger or a group of passengers in the taxi, and the taxi driver cannot do it twice at the same time. So once the journey is over, then the taxi service is also consumed. That no one can store the taxi service for future consumption. And the last feature is variability. Each service is unique and cannot usually be repeated in exactly the same way, making offering a standardized service to customers very difficult. For taxi service, from point A to point B, there may be more than 10 choices of routes from point A to point B. Maybe at 3 p.m. today, the taxi driver chose route 1 from point A to point B, but on the another day, maybe at 9 p.m., taxi driver can drive another route because he considers whether there's a traffic jam or any other considerations, or even for traffic lights as well. So for variability, for each service is unique, and it cannot be repeated in exactly the same way. And for the areas that the service departments may need to work with accounting departments, there are 3 issues or areas that we would like to look at. First, charge-out rates. This is the hourly rate which the company charges clients. It should be higher than the salary, as it should include a share of overheads. For example, training and any profit the company wishes to make should be included as overhead. However, if the charge-out rate is too high, customers will not use the service, and many accounting firms base charge-out rates for their staff on an roughly estimated about 3 times that the person's salary. Other than the charge-out rates, the service departments need to work with accounting departments on estimating cost. If the service takes longer to provide than expected, the company may not be able to pass on the extra cost. The problem here arises in determining the amount of overhead to be included in the charge-out rates. For example, if the service takes much longer than expected or in the budget, it's quite hard for the service department to ask for extra charge because of the extra time incurred. The audit firm sometimes will put the hourly rate table and send to the customer, and in the engagement letter, it will highlight that the billing is not confirmed and finalized. Because if there's any extra hours, the audit firm has the right to charge the customers. Problems measuring benefits. A company with effective service provision has happier customers, and happy customers are more likely to buy from the company in the future. therefore leading to lower selling cost. But it is very difficult to measure these benefits. It's about the long term, because for market conditions, it may mean that the charge-out rate contains a very low profit element. Some company may challenge whether it is worth to carry out the services to the customers. But as stated here, the problem is of these benefits are intangible. But they are real, even though they are intangible. And a company with effective service provision has happier customers. It definitely is better than those companies with ineffective service provisions because of the unhappy customer or a poor customer relationship. So the problems of measuring these benefits is quite hard to do it. So in-class question time here. The statement, most services provided by an organization will be created at the same time as they are consumed. And which feature of services is being described? We have A, B, C, D. A, intangibility, B, inseparability, C, perishability, and D, variability. And just recall what we discussed in this class, and you can choose or you can pick the right option here.